The trade war has caused a roller coaster in the stock market, as we have talked about over the last few days. Down for a second day, it attempted to pare the losses, but simply couldn't in the weight against it of tariffs. So now the Dow has shed more than 1,300 points in the last 2 days. The sentiment shifted sharply last month. The Trump bump following the inauguration disappeared. I asked Mohammed Al-Arian yesterday how investors should approach investing in this market.
So investors have to be very honest with themselves. What is a recoverable mistake? What's an unrecoverable mistake? If, for example, you're using your grocery money in the stock market right now and it goes, that's an unrecoverable mistake. So you've got to be very honest with yourself in terms of what's recoverable, what's unrecoverable, and what's recoverable, just wait, because this will pass. What's unrecoverable, you should be careful not to lose the money you absolutely need.
Art Hogan's with me, Chief Market Strategist at B. Riley FBR. Art is going to make some sense of it all. The recoverable versus the irrecoverable. I understand, as we know, what Mohammed's talking about, but it's very difficult to do because you're sitting watching gains disappear in the market. You don't want to sell and, if you will, lock in a loss or a taxable event. But the level of uncertainty is just everywhere.
It certainly is, Richard. And I think Mohammed made a great point about grocery money. The problem is that basket of money has to get larger as the price of groceries gets larger. I think one of the things you have to think about in this market and what's really been moving us around is that we came into this year thinking that this new administration would be pro-growth and pro-business, but unfortunately they unleashed all the negative parts of what they'd like to get accomplished first. Right. So there's no tax cuts, there's no cuts in regulation. It's just the immigration and tariff piece. And a lot of folks that look at this market were saying, well, let's go back to 18 and see how that laid out. And the problem with that analysis, Richard, is that in 2018, we had just done a corporate tax cut. The Tax Cut and Jobs Act was in 2017. So corporations had a lower tax rate. At the same time, inflation was below 2%. So we had a buffer for the inflationary impacts of tariffs. At the end of the day, those tariffs were largely against China and not on consumer goods. What's being proposed right now is the opposite of that. In a place where we already have high inflation, we've got the problem with even higher inflation with tariffs.
And those tariffs, I mean, compared to 17, 18, 19, which were very specifically targeted on certain countries and certain products. But this is general. It's across the board. And it seems to me that the president is wanton and determined regardless of what comes back. He wants to, it seems to me, he wants to prove the point on tariffs. And in that case, I don't know how the market withstands that sort of pressure.
Yeah, I think that's true. And I think that, it's the explanation or the goalposts continue to be moved, whether it's immigration and fentanyl as being one thing, whether it's, unequal trade balance or reciprocal tariffs, that's another, or is this a potential revenue generation, which, doesn't have a lot of economic sense to it. So at the end of the day, unless and until we know what those goalposts are and what the end game is, there's going to be a great deal of uncertainty. That has manifested itself in uncertainty around consumers, uncertainty around corporate leadership, and certainly uncertainty around investment. And I think that's why we've frozen up in this market, and we've been on a downward trajectory for about a month, wiping out, as you mentioned, all of the gains we saw post-election. Right.
Good to see you, sir. Art Hogan joining me. The one thing I know, Art, is you and I are going to talk many more times on all these issues, and we're always grateful that you give us the time.